Hi, this is CH. This video is part of a series of videos titled My ABCs or Absolutely Biased Comments on one mutual fund per video to share how an individual investor like you and I can try to find out more about a mutual fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product's sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Allianz Income and Growth Fund. Now, the first thing we need to figure out as an individual investor is where can we obtain information and documents on the fund. Allianz Global Investors has a decent Singapore website whereby the individual investor access should have all the necessary information and documents needed. Do make sure you don't go wrongly to the generic Allianz website, which is mainly for their insurance-related business. I will be briefly referring to Voya Investment Management and its website in this video. I will explain its relationship with Allianz Global Investors later. I will also be grabbing some stuff from Morningstar website for this video. Morningstar is not exactly retail investor friendly in terms of its website navigations, but it does have very useful dynamic performance charts, which is good to help explain the fund. You can of course also get some information from your distributor, which is your bank or online platform that you buy funds from, as long as they have the fund on their offering list. And finally, the web helps to cover most of the remaining gaps. Let's start with some basic background info on the fund provider, Allianz Global Investors. Allianz Global Investors, also commonly referred to as Allianz GI or AGI, is the original asset management arm of Allianz since 1974 and was properly established as a global integrated investment firm in 2012. Allianz is the world's largest insurance company and Europe's largest financial services company, so there is definitely a high degree of business stability for Allianz Global Investors. Singapore investors should find Allianz a familiar name as it has recently attempted but failed to acquire the NTUC income insurance business in Singapore. Another popular fund provider, PIMCO, is actually also a subsidiary of Allianz, though both asset management brands run independently. As of September 2024, Allianz Global Investors has over 600 investment professionals located in over 20 office locations globally, managing about 560 billion euro of assets under management. Assets are quite evenly distributed across equities, fixed income, multi-asset, and private markets solutions. Considering insurance company-owned asset management businesses tend to be fixed income heavy, Allianz Global Investors is rather well diversified for its exposures. The firm doesn't follow a single investment philosophy or approach, but instead is open to different active investment strategies, which is probably an extension of its history as a conglomerate of boutique investment teams. I couldn't find any details in the website specific to the Singapore business or the regional awards obtained. It would be nice if Allianz Global Investors can add a bit of this information in the website. Now, the relationship between Allianz Global Investors and Voya Investment Management is a bit complicated. Back in 2022, Allianz was involved in a fraud case relating to one of its US products. The outcome of that was that Allianz transferred majority of its US onshore funds and US-based managers to Voya IM and took a 24% stake in Voya IM. For fund strategies that also has international versions, the managers who were transferred to Voya would continue to manage the funds even though the international funds remain under the Allianz Global Investors business. The Allianz Income and Growth Fund is one of such funds that has this odd arrangement. Now that we know a bit more about Allianz Global Investors, let's take a look at the fund. Structure-wise, the Allianz Income and Growth Fund is a sub-fund under the Allianz Global Investors Fund, or sometimes referred as Allianz GIF fund family. Allianz GIF is set up as a Luxembourg SICAV company structure and is UCITS qualified. Singapore-wise, the fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. Let's move on to the fund strategy. The fund prospectus and PHS provides a very short description of the investment objective that I think is rather useless, except for implying that this is a US-only multi-asset fund. The documents also additionally gives a list of investment restrictions, which is nice to know, but through the years I have not seen the fund getting close to any of these limits. An important note is that it specifies there is no benchmark for this fund. While I think there should be, but more on that later. The fund fact sheet also simply just repeat the short one-liner of investment objective. So let's chuck these aside as they don't really help us understand what the fund is trying to do. The Income and Growth Fund is a flagship product for Allianz Global Investors for the past decade, and so there is a focused fund webpage for it that thankfully contains some useful stuff, including a fund leaflet and a strategy booklet, as well as an intro video on the fund. The fund leaflet document provides the exact strategy information we need. The fund runs a multi-asset strategy with 1/3 US high-yield bonds, 1/3 US convertible bonds, and 1/3 US equities. It is important to note that this equal-weighted three sleeves approach is a static allocation, so do not expect the fund to make any dynamic adjustments to the allocation in accordance to changes in market conditions. The fund is purely US-only exposure. There are three aims stated. The first, and also the top priority of the fund, is to provide consistent income. The second is long-term capital growth. These two contribute to the name of the fund. The third is upside participation and downside management, which is something all fund managers aim to achieve. We will see whether the fund meets these aims when looking at performance later. There are also 7 potential sources of income listed. The first 3 are natural coupons and dividends from the bond and equity positions. 4th to 6th are capital gains on the same positions, but take note, these are also listed as sources of income, which implies the fund strategy will use these capital gains to pay out as income as well. The 7th is covered call option premiums on the equity positions. And do also take note that in the pie chart, the 1/3 equity component is stated as equities with covered calls, which suggests the equity exposures are mainly used for the covered call strategy. Now, the fund strategy as elaborated here looks quite straightforward and appears to be a diversified multi-asset approach to invest in the US markets. But let's deep dive a bit more to understand what the fund is really doing. Let's take one step back and see what an investor really gets from such a 3 sleeves strategy. To do this, I am using various iShares ETFs to represent each of the 3 sleeves, as well as using the free ETF chart generators from ETF Replay website. What I have provided here is a 10-year total performance chart of the iShares Russell 1000 Growth and iShares Russell 1000 Value ETFs to represent the US equity markets, separated between growth stocks and value stocks. And also iShares iBoxx High Yield Corporate Bond ETF to represent the US High Yield sleeve. And lastly, the iShares Convertible Bond ETF to represent the US Convertibles sleeve. I would imagine the equity sleeve in the fund to be more aligned to Russell 1000 Value, as they are firstly meant to be higher dividend stocks, and secondly meant to have covered call options, which limits the upside potentials of the stocks. The Russell 1000 growth is included to show what such a strategy is missing out during strong bull markets. So, the first thing to note is that the US markets have been in an uptrend on the long run. If you had invested in any of the 4 ETFs 10 years ago, you would have made profits today. Following the same logic, by investing in a fund that has these components, you should be profitable in the long run, assuming US markets remain strong. The question is how profitable and whether it is enough for you, but I will talk about that later. The second thing is that it is clear that high-yield bonds have lower returns and lower risk than equities. So by allocating a portion of the portfolio to high-yield bonds, the fund is accepting a lower return potential in exchange for a lower volatility component. The third thing is that convertible bonds appear to have performed quite similar to Russell 1000 value, except for the massive spike and then decline during the COVID period. The fourth thing is that both the high-yield bonds and convertible bonds have high positive correlation with Russell 1000 value. While it can be deduced from the performance charts, here are the correlation charts to make it clearer. High positive correlation means that when equity markets fall, it is highly likely for high-yield bonds and convertible bonds to fall as well. This translates to a poor diversification effect for the three sleeves strategy. So, coming back to this chart again, we can imagine the fund to be initially a pure 100% high dividend value equity strategy, which would turn out to be similar to the Russell 1000 value blue line. In order to reduce the overall volatility, some returns has got to go. Therefore, high-yield bonds, which is the orange line that still has a high correlation to equities, is a good partial substitute. If we take out 33% from value equity and put into high-yield bonds, we would expect the eventual performance line to be slightly lower than the blue line. But how can we offset the reduction in returns? In comes convertible bonds, the black line, which has a high correlation to equities as well, and appears to have slightly better returns than value equities. So if we take out another 33% from value equities and put into convertible bonds, that should move up the returns slightly. The end result would be a portfolio that is almost similar to value equities for the upside participation, but with a slightly lower volatility for the downside management. Then all that remains is to decide how much distribution to pay out to investors for the consistent income. Therefore, for investors in this fund, the expectation should be to get a performance similar to Russell 1000 value, with perhaps slightly lower returns and lower volatility. If you are expecting to get a strong bull run that follows the mega tech stocks and AI teams, this is not the fund for you. Now that we have a better understanding of the fund strategy, let's see how it translates to the actual fund portfolio. This screenshot is from the November 2024 fund fact sheet. The obvious data here are the static asset allocation, which is the 1/3 high-yield bonds plus 1/3 equities plus 1/3 convertibles. There are some cash as a result of subscription inflows and also to handle redemption outflows. The country allocation also indicates this fund has a pure US exposure. Sector breakdown looks diversified. However, there is no indication how this gets split across the three sleeves. There are mega tech names in the top 10 holdings, which makes the fund appear to be growth-style biased. However, remember that the equity positions have covered call options, so upside is limited. Therefore, the eventual return expectation should still be more like value-style experience, even with these positions. If we bring back the 7 potential sources of income from the fund strategy and compare against the fund portfolio statistics summary, we can gather quite a few key information. It can be seen that high-yield coupons at 6.28% do look decent, but convertible bond coupons at 2.03% looks quite low. Equity dividends at just 1% are worse, although covered call premiums are not stated, and I would imagine covered call strategies would do quite well for the bullish tech names in the top 10 holdings in 2024. The rest would depend on capital gains for all the positions. The fund is over $50 billion in AUM, which is quite big for a US equity-like strategy. Number of holdings are also significantly higher at over 400, given the large fund size and also due to the nature of the three-sleeve strategy that needs more positions for better diversification. The fund used to have a US onshore vehicle, however that was transferred to Voya IM and the strategy had changed slightly, so I will not include details of that vehicle here. The earliest retail share class was incepted in November 2011, so the fund has more than 10 years of proper track record. As mentioned earlier, Allianz transferred the US onshore managers over to Voya IM in 2022, though they continue to manage the international funds under Allianz Global Investors. The Allianz Income and Growth Fund is one of the funds that have this odd arrangement. In the Allianz Global Investors website and fund fact sheet, you will find 4 named managers but with no further details, as they technically are not Allianz employees anymore. To get further details, we will need to go over to Voya's website and find the US vehicle, which has since changed and now called Voya Global Income and Growth Fund. In there, proper bios of the 4 fund managers can be found. All 4 of them move over from Allianz Global Investors and manage only the income and growth strategies. Justin is the CIO and co-head of the income and growth team. He also appears to be the key person responsible for the convertible bond sleeve with his past experience. Michael is a lead portfolio manager in the team. He has the longest work experience with Allianz than Voya and appears to be the key person responsible for the equities sleeve with his past experience on US large cap markets. David is also a lead portfolio manager in the team. He appears to be the key person responsible for the high yield bond sleeve given his past experience in US high yield bonds and credit default swaps. Lastly, Ethan is the most junior among the 4, and it looks like they are grooming him from a research analyst role to a proper fund manager role. A check on Morningstar shows that there should also be Willem, who is the other co-head of the team. Given the absence of his name, it might be possible that he has left the role recently. It is also useful to note that this team only started managing the fund from 2022 onwards, after the transfer to Voya. With about 3 years managing the fund now, there should hopefully be more stability in the team going forward. Next, let's go through the fund performance. The fund fact sheet provides a simple performance chart with some cumulative and annualized returns data. But without an official benchmark, there is nothing to compare against, so it's hard to assess whether the fund is doing fine purely based on this data. So let's chuck this aside as well and rely on the dynamic charts from Morningstar. Here, we have the full performance chart since inception for the AT US dollar share class, which has the longest track record among the retail share classes. At a glance, the fund appears to have performed decently, with mostly a consistent uptrend, save a bit of increased volatility at start and end of the COVID period. The fund delivered a 163.52% cumulative growth, which translates to about 7.7% per annum. Next, let's add in iShares Russell 1000 Growth ETF or IWF and iShares Russell 1000 Value ETF or IWD to show how the US growth and value equity markets have done. It can be seen quite clearly that the fund's performance is much more similar to IWD, though even lower in both returns and volatility. Again, the key message here is that this is not a fund that will participate in strong growth bull markets. such as what we have observed in tech and AI teams in the recent years. Even if the fund can hold such stocks in the portfolio, the intent is to extract a limited upside with associated lower risk through the covered call options. Next, let's throw in iShares High Yield ETF or HYG and iShares Convertibles ETF or ICVT to see how the three sleeves might have done individually. It can be seen quite clearly that the fund's performance is somewhere in between IWD and HYG, which suggests the fund could have passed off with a 50-50 allocation to Russell 1000 value and US high yield bonds. The fund is slightly closer to HYG, partly due to the ongoing fees charge. Convertibles didn't become popular in the retail space until about a decade ago, so ICVT doesn't have that long a track record. But the high positive correlation among the three sleeves and the fund itself can be seen clearly here. Let's tweak the starting date of the chart to align to the inception of ICVT. Here, we can see that convertibles can potentially help to generate additional returns above Russell 1000 value, but the returns are not consistent and can be volatile at times. So manager skills to pick and choose the better convertible bonds to invest in would be crucial. Here are the annualized and calendar year performance data from Morningstar. The fund delivered 6.7% per annum for the past 10 years and 7% for the past 5 years. If we use this as a gauge, the fund ideally should generate about 7% per annum in the long run. Calendar year returns look decent, except for the big market level drop in 2022. To be fair, returns for the fund are okay if we have a clear understanding of what should be expected from the fund. If I have to think of more appropriate marketing descriptions for the fund, I would call the fund strategy either a high yield plus solution that gives better returns than US high yield by adding some equity mix, or a value equity light solution that gives a proportionally lower return and lower volatility compared to typical value equity exposure by adding some high yield and convertibles. If you are expecting the fund to do a lot better than this, be prepared to be disappointed. The fund is obviously US dollar based currency, but it comes with a few Sing dollar hedged share classes, which is good for Singapore retail investors. Looking at long-term performance, the Sing dollar class tracks the performance quite closely, with about 1% per annum hedging cost on average. Last but not least, let's go through the share classes available for the Allianz Income and Growth Fund. The fund has over 70 share classes registered in Singapore and has a rather confusing naming convention for the share classes. Here, I have listed the retail share classes for both US dollars and Sing dollars currency options. Alphabet A denotes the retail share class that we use for Singapore investors. T refers to accumulation class. Note there are no accumulation classes available for Sing dollars. M refers to monthly distribution frequency. G refers to income distribution using gross distribution policy, which means it doesn't factor in the fees and costs of the fund. Distribution classes without the G would be using net distribution policy. I refers to income distribution with interest rate differential neutral policy, which means the hedging cost, whether positive or negative, does not get applied in the distribution. There is also a 2 after the G or I, which I was not able to find any specific elaboration in the prospectus. So we will have to assume it's some secret code that only Allianz employees will know. H2 refers to currency hedging, where the base currency is hedged against the hedging currency using forward approach. The AT accumulation class is the earliest incepted share class in 2011. The normal AM distribution classes were launched in 2012 and 2013. The AMG2 distribution classes were launched in 2017, and finally, the I classes were launched in 2024. I will cover the differences in distributions shortly. This fund is a flagship product for retail investors globally, and so there are many other currency share classes available. The A share class charges a 1.5% per annum management fee. Adding other expenses comes to a standardized 1.55% TER. Up to 71.43% of the management fee can be paid by the fund to distributors as trailer fees. I have no idea why the percentage number is so weird. The fund also allows distributors to charge up to 5% subscription fees, although anything more than 2% for mutual funds looks excessive. The share class distributions for the Allianz Income and Growth Fund deserve a separate section, because the distributions is the key objective of the fund, and also what made the fund popular in the retail space in the past decade. Here, I have listed the annualized distribution yields of the different share classes as per the November 2024 fact sheets. And you can see that the yields vary significantly across the share classes. Let me explain. The AMIH2 Sing Dollar class is paying out 8.2%, which is near identical to the AM US Dollar class. This is because the share class has an interest rate differential neutral policy, which basically means the hedging cost is being reduced in the NAV instead of distribution payout. The AMH2 Sing Dollar class shows the reverse, which pays out 6.6% because the hedging cost, in this case about 1.6%, is being reduced in the payout instead of the NAV. Staying on the AMH2 Sing Dollar class, this is a net distribution policy class. So except for hedging costs, all other charges, fees, taxes, and expenses are reduced in the NAV. The AMG2H2 Sing Dollar class shows the reverse, which has all these expenses reduced in the payout, where then it can only pay out 2.7%. It is useful to note that there are running costs beyond the fund TER, as it shows here that all these expenses total to about 4%. About the same amount can be derived by comparing the two US dollar distribution classes or by comparing the last two share classes on the list. Distribution payout and NAV capital retention is a left pocket right pocket matter. For the same fund, if you get more distribution payout, the NAV of the fund will become lower. I mentioned earlier that the fund looks to be able to generate about 7% per annum in the long run. So assuming the fund does generate a 7% return for the year, paying out a 8.2% distribution would mean that the fund NAV will have to get reduced by 1.2%. On the other hand, paying out 2.7% distribution would mean that the fund NAV grows by 4.3%. So as an investor, you will need to be clearly aware that your choice in the fund share class has a significant impact to the value of the investment in the long run. To give a clearer illustration, I use here a 10-year NAV chart feature from Financial Times website. The AT class is accumulation, so the NAV growth is the actual total return an investor will get. The AT class has generated about 90% cumulative returns in this period, which we can simplify it as about 9% returns per year. The AM distribution class, on the other hand, has seen NAV flat to negative through the same period, with about a minus 20% drop in NAV at the end. Now the difference between the two lines is the distribution obtained and what an investor can do with the distribution. Assuming the AM class has paid a 10% distribution each year, that translates to a 100% distribution minus 20% NAV drop, which ends up only 80% total returns. In reality, as the share class NAV goes down, the actual payout in dollar terms will also get reduced over time if the yield percentage stays the same. So, coming back to the list of share classes, if you are clear about the consequences of the high payout and still wants the income, go ahead with the 8+% distribution yield share classes. If you don't really need the income payout and want to see the investment grow through the years, go with the accumulation or lowest distribution yield share classes. And finally, if you still need some income, the 4+% distribution yield share classes should be good enough. With that, let's summarize our findings. Allianz Global Investors is the asset management arm of Allianz, the largest insurance company globally. The AUM isn't as big as some of the other fund providers, but having a big size parent helps to ensure stability of the business. The fund strategy is not complex, which is basically a static equal allocation to US high yield, US convertibles, and US equities with covered call options. However, an investor will need to think through to understand what this strategy would lead to in terms of returns expectations. For example, the three components are highly correlated and therefore diversification effect is not good, or that the fund is expected to behave more like a high yield plus or value equity-like solution. There can be more explanation on the returns attribution for the fund strategy like this. For example, why is the equity dividends so low at just 1%? Is that because covered call options on growth stocks can currently generate better returns? Providing more details can help investors understand the fund better. It is not ideal that the fund manager's information and bios are only available at Voya website. I would imagine most retail investors would not even know how to find it. The lack of a benchmark for the fund is questionable. It should be easy to construct a customized benchmark using 3 indices to represent the 3 sleeves in the strategy. So why not? Having no benchmark to compare against also makes it more difficult for investors to assess whether the fund is doing well, or to appreciate if the managers are making any right calls to deliver alpha returns. The fund comes with a variety of distribution share classes that have different levels of payout yields and currency classes, which allows investors of different needs to pick and choose. However, that is assuming the investors are aware what the different share classes mean, which needs quite a bit of effort to go through the prospectus. In the end, my thoughts on the Allianz Income and Growth Fund is quite mixed. I am aware that some retail investors in the past subscribed to the fund simply because of the high distribution payout yields, but not really understanding the return expectations and the impacts to the capital of the investment. The Allianz Income and Growth Fund has specific characteristics and is suitable for specific investor needs. So I do hope the distributors of the fund can do a better job these days to explain the fund properly to their clients. This concludes my absolutely biased comments on the Allianz Income and Growth Fund. Would you invest in the fund or give it a miss? Or are you already invested in it? Do drop a comment to let me know what you think. Additionally, if you find this video useful and would like to see more related contents, please click on like, subscribe to the channel, and share this video to your friends. Thank you and have a great day.